If you only read the headlines from last year, you'd assume the esports industry was buried 6 feet under. Teams folded, major sponsors fled, and the esports winter became the dominant narrative for tech journalists. But while everyone was writing obituaries, the smart money was quietly doubling down. Here is the hard reality the media missed. The market is projected to hit a massive 17.5% compound annual growth rate, racing toward a $5.118 billion valuation. By 2029, the winter wasn't a death spiral. It was a necessary forest fire clearing out bad venture capital to make room for sustainable revenue. While the news focused on layoffs, US viewership actually climbed from 217 million hours to a projected 34.8 million dedicated viewers by 2026. Today, we are breaking down exactly how this pivot happened. I'm going to show you the CEO scorecard that reveals why a digital skin in Valorant is a significantly better business asset than a physical jersey in the NBA. To understand where the money is going, you first have to understand why it vanished between 2021 and 2023. The industry suffered from a classic valuation bubble. Organizations were operating on inflated venture capital runways rather than actual revenue. They were burning cash to acquire fans who weren't spending money, assuming the next round of funding would always be there. When interest rates rose, that free money dried up, and the organizations relying on burn rates collapsed. But here is the critical distinction. The business models failed, but the product, the actual viewership, never stopped growing. Take the LCK or League of Legends Korea as your primary case study for resilience. Despite global economic headwinds that crushed other sectors, they maintained over 100 million peak viewers in 2025. They succeeded because they didn't just rely on selling tickets, they pivoted hard into mobile integration, meeting their audience exactly where they live rather than forcing them to watch linear broadcasts. This separation of winners and losers is even clearer when you look at North America. While traditional esports organizations panicked, groups like FaZe Clan and 100 Thieves executed a massive pivot. 100 Thieves specifically shifted from being a pure competitive team to a lifestyle and content empire. By diversifying into apparel and creator-led entertainment, they reached a $460 million valuation. They realized that winning trophies is great for ego, but selling hoodies, keyboards, and content integrations is what actually pays the rent. Then there is the data point that proves the floor is solid: audience stickiness. In the Valorant Champions Tour, regional qualifiers, not even the finals, drove a record 185 million hours watched. This proves that even when ad spend contracts, the audience retention remains elite. The product remains viable because the viewers are addicted to the competition. The narrative that esports died is simply a misunderstanding of market cycles. The hype money left, yes, but while the speculators were exiting, the infrastructure for real monetization was being built in the background. The industry didn't shrink, it just traded inflated VC dollars for high-margin digital revenue. To really understand why the money is flooding back into this sector, you have to stop looking at esports like it is just video games and start looking at it like a balance sheet. When you strip away the flashing lights and the stage pyrotechnics, the business model of competitive gaming has fundamentally shifted. We can visualize this using what I call the CEO scorecard. Imagine you are holding two financial reports side by side. On the left, you have a traditional sports franchise, let's say a mid-tier NBA or Premier League team. On the right, you have a modern esports organization operating in 2025. When you compare them across three critical metrics, the reason for the smart money pivot becomes undeniable. The first metric on our scorecard is customer acquisition cost, or CAC. In the traditional sports world, acquiring a new loyal fan is incredibly expensive. Teams rely on linear television contracts, massive billboard campaigns, and local radio spots to keep you interested. The data shows that for legacy sports, the cost to acquire and retain a paying fan hovers between $10 and $20. They are fighting for attention in a saturated market using expensive analog tools. Now look at the esports column. Because the audience is digitally native, living on Twitch, Discord, and X, the acquisition cost drops to between 50 cents and $1. Esports organizations don't need to buy Super Bowl ads. They just need a viral clip on TikTok or a co-stream with a popular creator. This efficiency means that for every $1 million spent on marketing, An esports org captures 10 to 20 times more eyeballs than their traditional counterparts. But the second metric is where the real revolution happens. This is the single most surprising insight regarding the industry's profitability: digital item margins. In traditional sports, merchandise is a volume game with terrible margins. If a team sells a jersey for $100, they have to pay for the cotton, the manufacturing, the shipping, the warehousing, and the retail staff. By the time the fan puts it on, the team might only clear 40 to 50% profit. It is a heavy logistical nightmare. Compare that to the Riot Games or Valve model. When a fan buys a digital skin in Valorant or Counter-Strike, the margin is practically infinite. The cost to produce the first digital skin might be a few $1,000s in designer salary, but the cost to produce the second, the 1,000th, or the millionth copy is zero. There is no shipping, no cotton, and no warehouse. The profit margins on these digital assets sit between 85 and 95%. This is why the industry generates over $2 billion annually from skins alone. This high-margin revenue stream is the financial engine fueling the entire pivot. It effectively subsidizes the competitive operations, allowing teams to operate with leaner physical footprints while generating cash flow that traditional retail simply cannot match. The third metric on our scorecard is sponsorship ROI, and this is where the stickiness data we mentioned earlier pays off. Sponsors are becoming obsessed with attention density. In legacy media, viewers skip commercials or look at their phones during breaks. In esports, the brand integration happens directly on the map or the character. Using Counter-Strike 2 as the benchmark, the record-breaking 372 million hours watched in recent tournaments didn't just offer passive views, it offered active engagement. Sponsors targeting Gen Z are seeing a 4 to 6 times return on investment in this space, compared to a saturating 2 to 4 times ROI in legacy media. When you combine dirt-cheap acquisition costs with 90% profit margins and superior ad performance, you realize why the death of esports was a myth. The unit economics are actually superior to the industries that were supposed to replace them. These superior unit economics are exactly why traditional institutions are finally forcing their way into the ecosystem. For years, the debate around esports and the Olympics was philosophical. People argued over whether gamers were athletes or if clicking a mouse required the same dedication as running a marathon. But while the public argued about definitions, the International Olympic Committee was looking at a much scarier set of numbers: the age of their audience. The strategic shift we are seeing now, the creation of the Olympic Esports Games, has almost nothing to do with a newfound respect for gaming. It is a desperate customer acquisition play. The average viewer for the traditional Olympics is over 50 years old. That is a demographic cliff that terrifies advertisers. If the Olympics cannot capture the under 30 demographic, their media rights value will plummet over the next decade. The IOC didn't cave because they love League of Legends. They caved because they need to access the 3 billion global gamers that their traditional broadcasts cannot reach. We saw the first major signal of this institutional buy-in with the Esports World Cup. With a $75 million prize pool, it shattered the ceiling of what a tournament could look like financially. It wasn't just a competition, it was a proof of concept for a multi-game, club-based ecosystem that mirrors the Olympic structure. The IOC watched this closely. Their decision to partner and eventually launch their own dedicated games, likely fully integrated by 2027, is a signal that the experimental phase is over. We are moving beyond exhibition matches and entering an era of formal medal events. This brings us to the concept of demographic arbitrage. In finance, arbitrage is taking advantage of a price difference between two markets. In media, the IOC is trying to arbitrage attention. They are trading on the prestige of the Olympic rings, a brand that means everything to older generations, but very little to Gen Z, in exchange for the attention of the 18 to 34 demographic. This is why the debate about gamers as athletes is irrelevant. From a business perspective, the goal isn't to prove athleticism, the goal is to secure the next 50 years of relevance for the world's largest sporting organization. When you see the Olympic rings next to a gaming monitor, don't view it as a cultural victory for gamers, view it as a business transaction. The traditional sports world has realized that their audience is aging out, and the only way to refresh their customer base is to buy into the infrastructure that esports has built. They are not here to save esports, They are here because esports is the only thing that can save them. This massive institutional shift creates a vacuum for talent, which leads us to the most important part of this breakdown: how you can capitalize on it. That projected 17% growth rate translates directly into specialized hiring needs. If you want to capitalize on this pivot, here is your 90-day action plan. First, esports analysts. Drop the generic game knowledge and learn Python or Tableau. Your goal is to build a GitHub portfolio analyzing complex VCT engagement data. Second, sponsorship managers. Focus entirely on ROI tracking and negotiation. Pitch mock valuation decks to 5 mid-tier organizations on LinkedIn. Third, content producers. Shift your focus to content-first organizations like G2. Launch a Twitch channel today with a 30-day streak of recapping LCK matches to prove consistency. Finally, event coordinators. The expanding World Cup circuit needs logistics experts. Volunteer at local tournaments and certify your PMP basics immediately. The industry didn't die, it just grew up. The real money is now in the infrastructure, not just the prize pools.